Good day and welcome to the Virtu Financial 2020 fourth quarter earnings call. All participants will be in a listen-only mode. Should you need assistance, please signal a conference specialist by pressing the star key followed by 0. After today's presentation, there will be an opportunity to ask questions. To ask a question, you may press star then 1. Please note that this event is being recorded. I would now like to turn the conference over to Deborah Belavan, Head of Investor Relations. Please go ahead.
Thank you, operator, and good morning, everyone. Thanks for joining us. Our fourth quarter and full year results were released this morning and are available on our website. On this morning's call, we'll have Mr. Douglas Cifu, our CEO, Mr. Joe Maluzzo, our Co-President and Chief Operating Officer, and Sean Galvin, our Chief Financial Officer. They'll begin with some prepared remarks, and then we'll take your questions. After just a few reminders. Today's call may include forward-looking statements which represent Virtu's current belief regarding future events and therefore subject to risks, assumptions, and uncertainties which may be outside the company's control. Please note that our actual results and financial condition may differ materially from what's indicated in these forward-looking statements. It's important to note that any forward-looking statements made on this call are based on information presently available to the company, and we do not undertake to update or revise any forward-looking statements as new information becomes available. We refer you to the disclaimers in our press release and encourage you to review the description of risk factors contained in our annual report and Form 10-K and other public filings. During today's call, we'll refer to both GAAP and non-GAAP results. In addition to GAAP results, we may refer to certain non-GAAP measures, including adjusted net trading income, adjusted net income, adjusted EBITDA, and adjusted EBITDA margin. Non-GAAP measures should be considered as a supplement to and not as superior to financial measures prepared in accordance with GAAP. We direct listeners to consult the investor portion of our website where you'll find supplemental information referred to on this call, as well as reconciliations of non-GAAP measures to the equivalent GAAP in terms of in earnings materials with an explanation of why we deem this information to be meaningful, as well as how management uses these measures. And with that, I'd like to turn the call over to Doug.
Thank you, Debbie. Good morning, everyone, and thanks for joining us to review our fourth quarter and full year results. I'll begin today's discussion by touching upon the highlights of our performance, as well as some commentary on the recent market activity, and then Joe and Sean will provide more color on our detailed results and outlook. We'll keep our comments brief so we have plenty of time for Q&A. The fourth quarter capped an extraordinary year for Virtu. We successfully navigated the volatile markets created by the global pandemic, delivering record results for our shareholders, remaining ready to service our global client base, and taking care of our approximately 1,000 employees. I'm incredibly proud of our entire team that continues to step up and deliver amidst unprecedented market conditions. For the full year, we achieved record revenues and profitability. Our full year normalized adjusted earnings per share totaled $5.76, and our adjusted net trading income came in at $2.3 billion, or $9 million per day. I'm particularly proud that we maintained our discipline around costs, even in a year where we paused some merger-related cost reduction efforts, and we were able to achieve an impressive 73% adjusted EBITDA margin. We used our substantial cash flow this year to reduce our long-term debt by $289 million and initiated a share repurchase program. I am pleased to announce that the $100 million share repurchase program that our board approved last quarter has been increased to $170 million, of which we have already executed $15 million. This is in line with our comments last quarter that we were going to direct excess cash flow to return capital to shareholders in the form of buybacks. Going forward, we expect to continue this trend, balancing debt reduction, share buybacks, and reinvestment in our business. We successfully executed against the opportunities presented in the fourth quarter as we outperformed the prior quarter as well as the overall market environment, realizing $456 million in adjusted net trading income, or $7.1 million per day, and $1.18 in normalized adjusted EPS. For the fourth quarter and full year, both our market making and execution services segments delivered solid performance. Starting with market making, our customer wholesale and non-customer businesses performed exceedingly well in Q4 and in 2020. Our continuous enhancements to our trading strategies, technology, and asset class expansion delivered substantial returns by improving our yield on the opportunities presented this quarter, which included better than average volumes and levels of volatility that remained persistently elevated relative to prior years. On the customer side, in 2020, we executed over 1.27 billion orders for our wholesale customers, which included providing approximately $1.3 billion in price improvement to retail investors. We provide wholesale market-making services to retail investors across over 200 platforms, ranging from retail and private client businesses of banks and global financial institutions to online retail firms, which provide immediate execution at or better than the national best bid or offer in over 8,000 listed securities in the United States. In addition, our non-customer market-making business delivered stellar results in 2020. We saw strong performance in a number of categories in the fourth quarter, in particular around our new options desk and the ETF block business, more on that later, as well as our European and APAC equities businesses. 2020 also marked the first full year of operations for our expanded Virtu Execution Services, or VES business, following the merger with ITG. I am pleased to report that the fourth quarter saw record results for our VES segment with $135 million in adjusted net trading income. We saw strong growth across all regions, delivering a 29% increase in adjusted net trading income versus Q3. This business, led by Steve Cavoli, really hit its stride in the fourth quarter. As we expected when we acquired ITG, marrying Virtu's technological capabilities with ITG's strong suite of workflow, analytics, and brokerage service products has led to increased client engagement across the board. In addition, VES provides a stabilizing force, reducing overall quarter-to-quarter variability in our results. As we grow this business and prioritize cross-selling to existing clients, it's important to note that today over 1/3 of our clients utilize multiple products or are engaged in multiple regions, which drives more value for these clients and a relatively steadier revenue base for us. The impressive results of our VES business aren't immediately apparent in a year where our market-making results are so substantial. But the VES business is a steady revenue stream that balances our naturally more volatile market-making business. With 2020 in the rear view, 2021 is off to an impressive start. Based on preliminary results, our quarter-to-date 2021 performance remains robust and comparable to the record daily average we achieved in 2020. Finally, touching on the markets in the beginning of the year, total U.S. equity volume in January averaged 15.7 billion shares. Notional volume was 621 billion per day. We continue to be there for our clients and provided $134 million in price improvement in January alone. Naturally, we don't expect this level of activity to persist throughout the entire year, but we are encouraged so far by the start of the year. Now I will turn the call over to Joe, who will review some of our growth initiatives and progress versus our strategic plan. Joe?
All right, thanks, Doug. I'll review some of our growth initiatives as well as a recap of our strategic overview that we presented with the third quarter results back in November. If you look at slide 7 in the supplemental materials, you will see that in 2020 we realized $166 million, or 7% of adjusted net trading income from these initiatives. While results in these businesses will be volatile, it's important to note that these businesses did not exist a few years ago. We made substantial progress this year in options, and we will be continuing to expand our symbol and venue coverage and the scope of our business in 2021, having spent 2020 building out our core options infrastructure. Our ETF block business has also been a success story. We have expanded our customer-facing presence, resulting in meaningful growth in net revenues, as well as providing us additional opportunities to grow into corporate bonds as a market maker. An effort already underway and one that we expect to contribute to revenues in 2021. Importantly, our Virtu Capital Markets business is an example of how we leverage the capabilities of our VES business to offer execution services to a new segment of the market and grow revenues. In late 2019, we identified an opportunity to execute at-the-market offerings by hiring a small group experienced in this area. Together with the execution and routing capabilities of VES, This business bore fruit for us in 2020, and we expect it to continue to do so in 2021. Discussing further our strategic plan that we outlined in detail in the quarter, I wanted to point out slide 12 in the supplemental materials. We outlined the specific operating expense plan as well as a grid that noted the potential levels of free cash Virtu would be able to devote to share repurchases at various levels of performance. This plan was meant to convey several things. First, to be specific about cost guidance as we head into 2021, when we expect to conclude the integrations of the large acquisitions we have undertaken. Second, to make clear that after the substantial deleveraging in 2020, our current overall debt levels represent a permanent capital structure regardless of the overall environment. And third, to be specific about a plan that through various market environments should result in our ability to generate substantial free cash flow devoted to returning to shareholders. Consistent with this plan and assessing where we are as we approach the midpoint of the first quarter, we are able to increase our share buyback plan by an additional $70 million. Now I will turn the call over to our CFO, Sean Galvin, who will provide further detail on our results.
Thank you, Joe. In the fourth quarter, adjusted net trading income, which represents our trading gains, net direct trading expenses, totaled $456 million, or $7.1 million per day, which is 75% higher than the year-ago quarter. Market making adjusted net trading income was $321 million, or $5 million per day, 109% higher than the year-ago quarter. Execution services adjusted net trading income was $135 million, or $2.1 million per day, a 26% increase year over year. For the full year, adjusted net trading income totaled $2.27 billion, or $9 million per day, 131% higher than 2019. Market making adjusted net trading income was $1.18 billion, or $7 million per day, 192% higher than the prior year. Execution services adjusted net trading income was $489 million, or $1.9 million per day, a 31% increase over 2019. Turning to expenses, for the full year, our cash and overall compensation ratios were 14.1% and 16.7% of adjusted net trading income, respectively, which are in line with our prior guidance. Adjusted EBITDA came in at $344 million for Q4, 200% higher than the prior year quarter, and $1.65 billion for the full year, 282% higher than 2019. We delivered an adjusted EBITDA margin of 75.4% for the fourth quarter by continuing to successfully leverage our efficient cost structure. As Doug mentioned, we have been diligent in paying down our debt, making $388 million in prepayments since the ITG acquisition in 2019, and have reduced our debt to $1.67 billion. Finance interest expense has decreased by $24 million to $68 million for 2020, compared to $92 million for 2019. We remain committed to our 24-cent quarterly dividend, which we have consistently paid over 22 quarters in every environment since our IPO. And our just announced $70 million increase to our existing $100 million share buyback authorization fully demonstrates our continued commitment to return capital to shareholders. I will now turn the call back over to the operator for Q&A.
We will now begin the question and answer session. To ask a question, you may press star then one on your telephone keypad. If you are using a speakerphone, please pick up your handset before pressing the keys. To withdraw your question, please press star then two. At this time, we'll pause momentarily to assemble the roster. And our first question today will come from Rich Repetto with Piper Sandler. Please go ahead.
Yeah, good morning, Doug and Joe and Sean. First, congrats on the super quarter here. I guess the first question, Doug, is, the question that all the investors are asking. If you look at the last two quarters, 4Q and 3Q, and you look at the market metrics, the volatility and volumes, and this is all on slide 5, that, they look very similar. But when you look at your results and, the NTIs are up 25% quarter over quarter, and I get execution services, and Steve did a great job. But they showed significant improvement in, your earnings. The leverage, was up. Your earnings were up 45% quarter to quarter. So how do you explain to investors, the differences and the outperformance? What really worked, I guess, in 4Q versus 3Q?
Yeah, good. Thanks, Rich. It's a good question. I think, look, clearly the environment continued to be attractive in the fourth quarter. You're right. The third quarter compared to the fourth quarter, there are some differences. If you look at the Interactive Brokers retail engagement, for example, in Q4 as compared to 3Q, which is the only public metric available with respect to how retail is engaging the marketplace, you'll see an increase, and you can also measure TRF volumes relative to on exchange volumes, and so certainly you see some positive trends there. As well, we continue to improve and get qualitatively better. It's hard, obviously, to measure and separate out sometimes the alpha from the beta, if you will, and we try to do that with some of the growth initiatives and whatnot. But within the existing, quote unquote legacy businesses, there have been, as I said in my prepared remarks, we continue to invest in technology and in strategies and whatnot. This is an organic business that you have to always be, investing in and getting better. So I just think the firm qualitatively has improved significantly in 2020, and you saw that in certainly in the fourth quarter. And you mentioned it, but it's worth, and I mentioned it in my prepared remarks, I was really, really happy with the performance of the execution services segment in this quarter. There's been a lot written about, the combination with ITG. Was it going to work? Will clients react to, an HFT firm, merging with an institutional business? And the marketplace has resoundingly said yes. And the unique nature of this firm, where we can marry a market maker that has both technology but also access to a significant central risk book, right, and make that available in a fully disclosed, efficient manner to our institutional clients, is unique. And clients understand the story, and more importantly, they see it in their performance. So we now have hundreds of institutional investors that are utilizing Virtu both as an agency broker, but also as a place, Rich, to source meaningful liquidity that might not otherwise be as robust and as available as they could find in other places. And so that story and that performance really is resonating with with our clients.
Got it. Thank you. I got one follow-up. There's been a lot of attention and speculation, on payment for order flow from the media and from, et cetera, from lawmakers. But if you had, and you sort of got into this a bit in the prepared remarks, but if you had to explain payment for order flow to, say, someone who's not as familiar with it, what points would you stress and really want them, I guess, to understand? And do you think there's any potential changes to payment for order flow coming?
Yeah, no, it's a great question. Obviously, it's front of mind, and we've tried very much to be front-footed in talking to clients and regulators and lawmakers about this over the years, and indeed more recently. I think the issue is really there's a misunderstanding with regard to what the term payment for order flow means, and people use it synonymously with wholesale market making, and frankly, that's a mistake, which leads to confusion and misinformation. Wholesaling, by its nature, is a business which we and a bunch of other firms are engaged in, where we are providing immediate execution on over 8,000 Reg NMS listed securities, as well as meaningful price and size improvement to every marketable order that comes in. So retail flow comes in, and by its nature, it's a little more balanced. And because of our ability to offer price improvement that is better than the national best bid and best offer, retail investors are benefited from us providing that service to the tune, from a Virtu perspective, of about $1.3 billion. And we estimate, as an industry, in 2020 that Virtu, Citadel, Susquehanna, Two Sigma, and the other firms, UBS, that provide this wholesaling service, provided $3.6 billion of price improvement. Nothing to do with payment for order flow, but literal price improvement off of the national best bid or best offer. So if you are a retail investor, you're able today to pay no commission, send an order of up to 9,999 shares, right, and receive either the NBBO or in many instances better than the NBBO on that entire order. There are a lot of institutional clients that are maybe listening to this that I've talked to that would happily take that deal, right? They're sending similarly sized orders in similar names, and they're paying us a commission, and they'd be thrilled if we get the touch, right? So retail investors, if you just take a step back at the ecosystem and what we and our competitors have developed in partnership with the over 200-odd trading platforms, et cetera, it's an unbelievable ecosystem that we all should be very proud of. And regulators and policymakers and folks that study the market that look at that say, and really look at the data, right, and avoid the histrionics, if you will, look at that and say, well, that's a great system, right? Like really, who is not benefiting from that system? And we're putting, risk capital up to, provide that service. And we get paid through internalizing, if you will, and realizing the bid offer spread as best we can. Some days, we don't make any money in that business, right? Because flow can be sharp and unidirectional and whatnot. And on balance, we do. But we've been at that business for over 20 years and invested billions of dollars in technology to make that work. Now, some retail brokers, charge the wholesale market makers a fee, and that's called payment for order flow, right, for executing the order flow. As I've said before, there's about a dozen or so firms that do that of the 200 retail brokers, platforms, et cetera, that we connect to. And as a general matter, we're agnostic, Rich, as to whether or not a broker charges that or not. We look at that as the same as any other fee, right, or charge that we're going to have from connecting to any other kind of exchange, financial intermediary, bank, broker. We're connected to hundreds of venues and banks and brokers around the world, and a lot of times we're paying for order flow, right? In this instance, it's with a handful of retail brokers. The important statistic is that we provided, over 3.5 times price improvement, if you will, to PFOL, right? So the vast preponderance of what we're doing as a service in the industry is providing price improvement. And then finally, all of the retail brokers that require payment for order flow do it at a standardized rate. And so really the competition between us and our competitive wholesalers is 100% based on what level of execution quality or price improvement can we provide back to their end users, right? So in terms of the ecosystem and who's ultimately benefiting, it really is the retail investor.
Got it. Thanks for the explanation, Doug, and congrats on the great quarter.
Thank you very much.
And our next question will come from Dan Fannon with Jefferies. Please go ahead.
Thanks. Good morning. So I wanted to tease out a bit more of the strength of the fourth quarter and what we've seen to start the year. Obviously, realized vol, as we look at that slide, didn't change much, but retail participation is up, and then you have the trading of kind of single or low price stocks and SPACs that are becoming a much larger part of the market. So could you talk to some of these other factors and maybe isolate some of the more specific things that are really incrementally different in this market?
Yeah, great question, Rich. Dan, excuse me. As I mentioned and you just alluded to, obviously when you have U.S. equity volumes that are 12 billion, I think yesterday was close to 15 billion, right? It's just an enormous flow that's coming through our system, and it's not just in the U.S. equities, and you'll see it in Canada and in Asia, right, where there's just enormous engagement in the marketplace. And so all of that kind of, it's not just from our retail partners that we're experiencing all of this incremental flow and incremental engagement. I think it's really part and parcel of certainly the United States, the Fed policy around zero rates and the stimulus in the economy. And you see that globally where folks are really engaging. And when you have zero interest rates, the equities market becomes